A note is the legal instrument that defines the exact terms and conditions of the loan. The interest rate factor can be either a fixed rate or an adjustable rate. On home loans, the monthly fixed rate charge is 1/12 of the annual rate. With an adjustable rate, there's an index rate, which is a market-determined rate beyond the control of either the borrower or the lender. And so the index rate can be based on a number of factors, including the U.S. Treasury constant maturity rate, the Thrift Institution Cost of Funds Index, LIBOR, or the Home Mortgage Rate Index. With an adjustable rate mortgage, there are different types of caps. Interest rate caps are limits on the changes in the rate that is charged. And so these limits can be periodic, they can be over the lifetime of the loan. And so an important question to ask is, does this cap apply to the teaser rate? And the teaser rate is a rate that's typically significantly lower than normal interest rates, meant to entice buyers to take on the mortgage. A payment cap is a limit on payment changes rather than a limit on interest rate changes. And so a payment cap could lead to negative amortization, which would mean that there would be unpaid interest added to the balance of the loan. So with negative amortization, the balance on the loan is actually increasing over time. And there are various arrangements for a fixed rate loan. It could be a level payment loan, or it could be a partially amortized loan. So a partially amortized loan would require two terms. It would require terms for the amortization, and then it would require terms to maturity. And then because it's only partially amortized, there would be a balloon payment at maturity. Other payment arrangements could include an interest-only non-amortizing loan. This is known as a bullet loan, or as we've mentioned already, negative amortizing loan, where the payment is actually not enough to cover the full interest that's charged, so the balance on the loan is increasing over time. So with a level payment loan, you can see that the payments are level, but the percentage of the payment that's applied to interest or to principal is changing over time. So in the early periods of the loan, more of the payment is going towards interest and less is going to principal. And then over time, that reverses. Traditional common law states that there is no right of prepayment unless it's explicitly stated in the note. Modern statutory cases indicate that the right of prepayment exists unless it's explicitly prohibited. So what loans have this right of prepayment? Well, all conforming FHA and VA loans have the right of prepayment and home equity credit lines. Loans that have a restricted right of prepayment are subprime home loans and jumbo home loans, and then most income property mortgage loans. So the prepayment penalties would include a percentage of the outstanding balance, some sort of yield maintenance. Because if you look at these from the perspective of the lender doesn't want these loans to be prepaid because they're anticipating to earning a certain yield. And so there could be a penalty in the form of yield maintenance that compensates the lender for the loss of that yield. Some other terms on a note would include non-recourse loans where there would be no personal liability on behalf of the borrower in the case of default. A demand clause, which would give the lender the right to require immediate payment on that note.